Good day. Today we are going to focus on the profit and loss and the trading account. So the information provided below is extracted from the records of Mzizi traders. We are expected to prepare the following accounts for the year ended 31 December 2020. So we are told to do trading account and the profits and loss. So let's go and do it. So let's first open the account of the trading account. So this is our trading account. This is the trading account. So we know that on the debit side of the trading account, we must have the cost of sales. And then on the credit side, we must have the sales, GJ, right? Now the information. The sales, they are 720,000. So we know that for the sales, we must see sales, and then we subtract the debtors allowances. So the first thing that we do, we take the amounts of sales, then we subtract the debtors allowances. So debtors allowances, there is 13,800. Okay, so the year here is ending 31 December 2020. So it's 31 December 2020, 31 December 2020. Okay, so if you don't understand the trading account, there's another video that I've uploaded where I've explained what is trading account. I've also explained the profit and loss in that same video. So you can just go to that video. It is written profit and loss account introduction. So just go to that video, then you will find the trading account explained. Okay, and then so let's go to and check in the transactions if there's something that is affecting the sales and the cost of sales. So number one is talking about the rent, then this one is the salaries, and then insurance, trading stock. So there's nothing that is talking about the sales and the cost of sales here. Okay, let's go back. So the cost of sales, they are how much? 400,000. So cost of sales, they are 400,000. So 720 minus 13,800, that is going to give you 706,200. Okay, and then the next step that you need to do is we check which side is bigger. So the side that is bigger here is the credit side. So you must equate both sides with the bigger side. Equate both sides with the bigger side. And then after that, you check it is big by how much. So how much is the difference between the two? So it is big by 306,200. So where do we transfer this to? We transfer this to the profit and loss account. So which is what we are going to do next. So we're going to transfer this to the profit and loss account. We have the profits and loss account. So we have the debit side and the credit side. So the dates we are told is 31 December, that is the end of the year. 31 December, that is the end of the year. Okay, so there's this amount that you are supposed to transfer to the profit and loss on the credit side. We know that if something is debited, it must also be credited. So there is 306,200. Okay, so it is coming from where? It is coming from the trading account. Okay, trading account. And then let's come back here. Now, if you have watched that video, you will understand that on the debit side, we record all the expenses of the business. On the debit side, we record all the expenses of the business. And then on the credit side, we record all the incomes of the business in the profit and loss account. Now, the expenses, they are here on the nominal account section and also the incomes. So, but let's first go to the transactions. Transaction number 1. The tenant paid up to 30 November 2020. Now, if you can remember here, it is written the year is ending on 31 December 2020. So this means that this year started on 1 January 2020 and then it ends on 31 December 2020. This is a full 12 months, right? But then here we are told that the rent has been received. The tenant paid up to 30 November 2020. So if the tenant paid the business up to 30 November 2020, it means that the month of December was not received. We only received the rent up to 30 November. So this means that we received the rent for only 11 months. So this means that this rent here, where's the rent income? The rent here, this one, it is for only 11 months. Okay, so we're told on the credit side we record all the incomes. So the rent income, it is 13,750 plus. So the rent of December was not received. But what do we know? The matching concept, it is saying that incomes and expenses, they should be recorded in a year that they belong in, even if they have not yet been paid or received. So this rent income of December, it belongs in this year, right? It belongs in this year, which is the current year right now. But then it was not received. But then we know that it must be recorded even if it was not received. Okay, so we're going to take the rent income, which is 13,750. We want to know that how much is the rent income per month. So we divide by 11 months, which is equal to 13,750. It is 1,250. So the rent income per month, it is 1,250. But then they continue to say the rent was increased by 80 Rand from December 2020. So this means that this tenant in December, he's not going to pay this. He's going to pay this amount plus the increment of 80 Rand, which is equal to 1,380. So this is the amount that you're going to go and add it here in the rent income. So if you add this, they're going to give you 15,080. Okay. The next transaction. one employee is omitted in the salaries journal. Now let's go and look at our salaries. So if you can see here, we have the salaries and also we have the employer's contribution. So we have the salaries and wages, and then we also have the employer's contribution. Okay, so the salaries and wages, they are 164,000. So we just open the brackets, 164,000. And then employer's contribution, 10,800. So they are 10,800 plus. Now let's go to the adjustment. So we are told that an employee's salaries was omitted from the salaries journal for December 2020. So this salary, it must be recorded in this financial year, and it was omitted. And we know that it belongs in this financial year. And we must remember the matching. It is saying that expenses, they should be recorded in a year that they belong in. So this salary of this employee, it belongs in this year that ends on December 2020. So we must go and record it in the salary of this year. Okay. Now, which money goes to the salary? The money that goes to the salary, it must be the gross salary. Okay. So the gross salary, it is the net salary plus the deduction. So which is going to give you 11,600. Okay. So we are going to have plus 11,600. So which is going to give you 175,600. Okay. And then we also have the employer's contributions. So the employer's contribution also, they are the expenses. So they were also omitted. So we must go and add them. So plus 350. 10,800 plus 350, which is going to give us 11,150. Okay. The next transaction, insurance amount. So now we're talking about the insurance. How much is the insurance? The insurance is 8,800. Insurance. So it's 8,800. So they are saying that insurance amount includes, meaning that this 2,400 is included here in this 8,800 because they are told that the insurance amount includes 2,400. Okay, paid for the period of 1 August 2020 to 31 July 2021. Now, our year starts on 1 January 2020 and then it ends on 31 December 2020. But then this insurance was paid up until for 31 July 2021. So this means that now this is no longer in our financial year. And we know that expenses, they must be recorded in a year that they belong in. So this means that here, there's an amount of insurance that does not belong in our year. And we must go and take it out. Okay, so it was paid for the period of 1 August 2020 to 31 July 2021. So from 1 August 2020 to 31 December 2020. So These are the only months that belongs in our financial year in this insurance that was paid of 2,400. But from 1 January 2021 to 31 July 2021, this is no longer our financial year, and this is a 7 months. This means that we paid an insurance of 7 months of which does not belong in our financial year. So we must go and take it out. But then now we must first see that how much is the insurance of 2,400 per month. So 2,400 divided by 12, that is equal to 200. So we want this insurance. This insurance of 7 months. So 200 times 7 months, that is equal to 1.4. So this insurance, it is for the next financial year. It does not belong in our year. And we are told that it is included in the insurance. So we must go and subtract it because it does not belong in our financial year. So what do we call this? We call this a prepaid expense, which is a liability. Okay, we call this a prepaid expense. If you can just go to the video, there is a video where I've explained what is a prepaid expense. You can just go to that video and then you will get the prepaid expense. Okay, so this is going to give you 7,400. Okay, the stock taking period on date 1 December, our financial year end, reflected the following on hand. Trading stock is 64,700. Now let's go and look at the trading stock and the trial balance. Let's go and look at the trading stock and the trial balance. The trading stock here in the trial balance is how much? The trading stock here in the trial balance is 70,000. So this one here is 64,000. So the business thought that they had a trading stock that is worth 70,000. But then after doing the physical stock taking, it was found that the trading stock actually it is 64,700. So what does this mean? This means that the business is making a loss here. Okay, the business is losing here. So what do we call this? We call it a trading stock deficit. So the difference between these two amounts, 70,000 and this one, we call it a trading stock deficit, which is an expense because the business is losing. So we know that the expenses, we record them here on the debit side of the profit and loss. Trading stock deficit. So we're going to have 70,000 minus 64,000, which is going to be 5,300. Okay, the next one, stationery. Stationery on hand, it is 107. So we have a stationery, GG. How much is a stationery? How much is a stationery? The stationery is 2,998. 2,998. So what do we do with the stationery on hand? So what happens is when the business buys the stationery or when the business buys the consumable stores on hand. So the consumable stores on hand, it includes consumable stores on hand include the stationery, packing material. It also includes the fuel. Okay, so these are the consumable stores, the items that are consumable in the business. So when the business buys these items, at that moment, they are treated as expenses. But then at the end of the financial year, if it is found that some of them are still remaining or some of them are on hand, because that is the same thing. If we are told that they are on hand, it means that it's the remaining one. So what you need to do is we can no longer treat them as the expenses because they are the remaining one. So they are now the asset. So what do? We need to go and subtract them from the expenses because they are no longer the expense. So we go and subtract this stationery as 107 from the stationery account. Why? Let's come back again. I'm saying when the consumable stores on hand are bought, so when the consumable stores are bought, at that moment when they are bought, they are treated as the expenses. But then, if it is found that at the end of the year, some of them are still remaining, or they are on hand, or they were unused, meaning that they are remaining, they cannot be treated as the expenses. So therefore, we need to go and subtract them from the expense account. So this is why we subtracted this stationery from the expense account, or which is the stationery. So this is going to give us 2,891. Number 5, water and electricity account of 412 for December is still payable. Okay, so meaning that it still need to be paid. Still need to be paid. So this means that it still need to be paid, payable. So now, water and electricity. How much is the water and electricity? It is 6,220. Water and electricity. This is water and electricity. It is 6,220. So we are told that it is still need to be paid. Okay, it is still payable. So if they are saying still payable, it means that it is still need to be paid. Now, what do we know about the matching? The matching is saying that expenses should be recorded in a year that they belong in, even if they have not yet been paid. Okay, so we are told that the water and electricity account of December is still payable, meaning that it still need to be paid. So what we have to do is we have to take this 412 and go and add it to water and electricity. Okay, to water and electricity because it belongs in this financial year, even though it still needs to be paid, but then it belongs in this financial year, so we must record it in this financial year. Okay, number 6, debtor 6 Peter is overseat for an unlimited period and cannot be traced. Write off his debt of 890 as irrecoverable. So what do we call this? We call this a bad debt. A bad debt. Okay, we call it a bad debt. We are writing off a debt. So we are bad debt. So the bad debts there. Okay. Number 7, interest on fixed deposit excluded the interest for the last quarter. So the year have how many quarters? The year has 4 quarters. 1, 2, 3, 4. So it is 3, 3, 3, 3. Okay, so the year has 4 quarters, which is going to give you 12 months. So we are told that we have only received the interest for only 3 quarters, because we are told that the last quarter was excluded. It means that only 3 quarters were received for the interest. So we are going to say the interest on fixed deposit, which is 11,250. We are going to divide it by 3 quarters so that we can know that how much is a quarter. So a quarter is 3,750. So this means that now we have the quarter that we need, 3,750, which is going to give us 15,000. Okay, and then number 8, depreciation must be taken into account as follows. Equipment, 15% per annum on the diminishing balance method. So if we are using the diminishing balance method, we must say cost minus accumulated. Cost minus accumulated. So for the equipment, we are using the diminishing balance method. So 230 minus 86,000. 230,000 for the equipment minus 86,000, which is going to give us 230 minus 86,000. It is 144,000 times 15%. So which is going to give us 21,600. So that is the depreciation. GG. So that is 21,600. Okay. Plus, and then on vehicle, it is 10% per annum on cost, meaning that you take the cost price and multiply it by the percentage. So 140,000 times 10%, which is going to give us 14,000. 14,000. So this is going to give us 35,600. Okay, now the last step. Now we check which side is bigger. So the bigger side here is the credit side. The bigger side here is the credit side. So we must equate the both side with the bigger side. Equating the both side with the bigger side. So the bigger side here is 336,280. 336,280. So if we check here, the difference is 82,527. So what do we call this? We call this a net profit. Okay, this is a net profit which must be transferred to the account of the capital. Okay, so that is your profit and loss. So we've calculated the gross profit. This is a gross profit. And then we have also calculated the net profit. So we are done.